This is Nick Kristoff with the Kristoff team, and I wanted to share some information today about construction loans and buying land and building. We're getting a lot of inquiries and doing a whole lot of construction related financing, and we get a lot of the same questions. And so I thought today I would give a little bit of information about the process of buying land, building a home on that, and then having an end permanent loan when you're all finished. There are really three main types of loans that you can use for this type of transaction. First is just a lot loan. If you're just buying land, you're going to use it just while you or prior to building on the property. A lot loan is exactly what fits that goal. There are some loans we'll talk about where you can incorporate the land in the purchase, but if you're looking at just purchasing a plot of land, you're going to hang on to it. That's a perfect way to go. A lot loans are typically shorter in term, anywhere between 1 and maybe 5 years. They usually have payments that are over a shorter amortization period. So sometimes you can have a higher payment, all things being equal, for a lot loan than you would maybe on your overall loan. But what you would end up basically is having a loan in place that allows you to secure the land so that you can build 1 to maybe 5 years down the road. When it comes time to build, that's when you can do a construction loan. And there are two ways to go about doing construction loans, but a construction loan at that time would let you build your actual residence. Lot loans typically have down payment requirements that are a little bit larger. You're looking at least 20% down, if not 25 or 30% down, depending on the specifics of that property. When it comes time to build and you're going into the construction phase, there is a construction only loan. And what that means is you have a loan that is used just for the building phase. You'll have a separate permanent loan at the end of the process, but just for construction. You'll have a loan that's typically interest only, starts at 0, or maybe the first job of that loan is to pay off that lot loan that you've got. And then the balance will grow starting at 0 and increasing up to the total loan amount. You use the funds throughout the process, the balance grows, and your payment will grow over time. At the end of that process, you move into the permanent phase. At that point, you're kind of on your own. You got to have an exit strategy. So you want to go into it with an exit strategy of what do I do at the end if I'm doing a construction only loan. There's another type of financing called a construction permanent loan. Construction permanent loans can be used to buy land and build construction at the same time. They can be used to pay off a lot loan and start the construction and go right into a permanent loan. They are kind of what they sound like, construction and permanent loans. So you may have a 30-year fixed rate construction permanent loan. It may have a 12-month period that allows you to do the construction. And then at the end of that, you may have 30 years or 29 years, depending on the type of loan. That is basically your repayment period. It looks and acts a lot like what your traditional mortgage would look like. So you would have an interest-only period. You start with a balance at 0 or paying off that lot loan again, starting there, growing up to the total loan amount. And then when you're all done with construction, you've got the CO on the property, you're ready to move in, it converts over into a permanent loan. And essentially at that point, you just make your payments like you would on any other loan. So that's a little bit of information on 3 different kinds of financing that are used to acquire land and build a home. There's plenty more information that we can give you. If you have any more questions, feel free to reach out to the Kristoff team.